So the next speaker and the final speaker of this part of the session is Dr. Xiaolei Xie. Xiaolei, can you start sharing your screens?
Yeah, of course.
So I know Dr. Xiaolei from very ago, back 2015, when I started my PhD. He was also in the same office doing his PhD at the University of Copenhagen. And after he finished his PhD in financial mathematics, things like that, he started working in several places, banks and investment companies. So he is the speaker of our session who has experience of working outside of university. So if any student has those kinds of questions, later they can contact him and ask. So Xiaolei, you can go ahead.
Yeah. All right. Yeah. So a bit of a change of topic now. Instead of chemical reaction networks, we'll be looking at finance and about. Oh, sorry. I think I clicked on something incorrectly. Let's see. So we'll be looking at stochastic differential equations in finance. Yeah, so I myself work at London Stock Exchange Group. So we do pricing and doing risk management. Yeah, these sort of things. So this kind of the mathematics that we use at work. So first of all, let me tell you about a model of stock prices. This model is called the geometric Brownian motion. So the symbols in the equation here, ST denotes the price of a stock at time t, and mu here is called the drift coefficient, and the sigma here is called the volatility of this stock. The interesting thing in this stochastic differential equation is, well, first of all, we have this WT, which denotes, yeah.
I think the slides are not moving. It seems it's frozen on the first page.
Oh, let me see. Can you see my slides here?
Yes. Perfect.
Okay, better then.
Thank you.
Thank you for reminding me about it. Right. Yeah, so we're saying that this dWt here is probably the thing that makes it different from normal non-stochastic differential equation. So dWt here means a random price movement, and dWt is called a standard Brownian motion. So that means the increment in the price, in the Brownian motion itself, it has a normal distribution. The mean of the distribution is 0, and the variance of the distribution is equal to the time differential. So we can see here that the increment of the price also has to do with the current price. And this Brownian motion adds a random element to the price evolution. So in order to deal with this kind of stochastic differential equations, the central tool is Ito's lemma. The lemma says if we have a stochastic differential equation of this form and we want to find out the differential of a function of this stochastic process, then we can use Ito's lemma to find it out. So the differential of a function of it is, first of all, it consists of these two parts. The first part is the first derivative of the function multiplied by the differential of the process itself. For the second part, you have to take the function to the second derivative and multiply it by the square of the differential of the process. And we see that the differential of the process is for the geometric Brownian motion is like this, and we want to take the square of this dst. So the rule to follow here is if we have dt squared, then that just gives us 0. If you have the product of dwt times dt, again, it is 0. The only non-zero term from squaring these differentials is when you square the dWt, and that gives us dt. So for example, if we don't have that the stock price itself on the right-hand side of the equation, and we simplify it to this form, then it's quite straightforward to calculate the differential of the price, of xt squared. In this case, we apply this Ito's lemma here, and then after a bit of algebra, we will arrive at this expression. So the dWt here is from the first derivative of the square, and it we carry this dWt term or the y to the end, and then there's another contribution in the form of dt from squaring the differential of xt, and in the end we get the first term here. So now again, let's get back to the this dxt here. Of course, what we really want to do is not calculating the differential, but we want to find out the value of this process at a given point later in time. So if xt has this simple form, then that is straightforward. We just integrate xt on both sides to get this form here, dt. We integrate that, we just get t, and these are constants, so we just get integrate dwt to get wt. So this is very straightforward expression. And because wt has normal distribution, we know that xt also has normal distribution, and the variance is given by sigma squared times t. So the variance of w t, the Brownian motion, its variance at time t is t itself. Okay. Then now we would like to really look at this model of the stock price itself. Then it's we need a little bit of a trick to find out the solution for the stock price. So instead of considering the stock price itself, we would like to consider the differential of its logarithm. So we apply Ito's lemma here, and then you take the first derivative of the logarithm, so you get the 1 over st here. Take the derivative again, we get this term, and by squaring dst, the only term that survives is dwt squared, and that gives us dt. So in the end, we'll get this expression for the differential of the logarithm of the price. Then we can solve this equation directly because no st appears on the right side, so we can express the logarithmic price into this form. So what we can see here is that the price on average will be growing exponentially, but there will be noise or uncertainty in the price movement, and that is described by the Brownian motion here. And how much the price will fluctuate is then determined by the parameter sigma, which is called the volatility. Okay, so now we have an expression that allows us to forecast future stock prices. Okay, so if you are brave enough, you want to believe in this simple model, then we are ready to buy some stocks and hopefully make some money out of it. But before we do that, we should look at how we can manage our risk. That really comes from the uncertainty, the price described by the Brownian motion. So let's say we buy one share of Apple at time 0. Think of it just now, the present time. And we buy that for $0, and we plan to hold it for some period of time. Let's go just time t. Then, of course, the central question is how much can we expect to earn from this stock investment, and how much risk will we be taking in so doing? Okay, so let's suppose that our profit or loss from buying this stock is X dollars, and we hold it for not such a long time. Then as a result, our profit or loss won't be so much bigger than S0, the stock price at the present time. And then we can approximate our logarithmic return as a profit or loss divided by our initial investment, which is the stock price now. And this is called the relative return. So we can see that the relative return is what we arrived at earlier at this expression. So that tells us our relative return has a normal distribution with a mean given by mu minus half sigma squared times t, and the variance is sigma squared times t. So that means the longer we hold the stock, the more we can expect to earn. That is, of course, the drift in the stock price is positive. That we have done some analysis, and we think that we are really looking at a stock that has growth potential. So that growth potential is described by this parameter mu. And then, of course, we have to think about how much the stock price will fluctuate randomly, and that is described by the parameter sigma. So we would like to calculate how much risk we'll be taking. But first of all, how do we how much can we expect to earn, right? People are willing to take higher risk if they are also expect to earn more from the investment. So first of all, we know that our expected return can be expressed as this expression. So what is our expected return in this stock investment? So the way to do it is, of course, we look at the historical stock prices, and we'll calibrate this model and found out the values of the parameters of mu and sigma. Then we just insert the calibrated values of these two parameters into this expression to get our expected relative return. So if you have found out these model parameters, mu equal to 0.2, sigma here 0.3, but of course here these values are annualized. So this mu of 0.2 would mean that you expect the price to go up by 20% in a year, and the sigma of 0.3 is approximately, you can think about it as the annual fluctuation in the stock price is around 30%. So with these parameter values, we can calculate that our expectation of the relative return is 15.5%. Okay, so now we have an idea about how much to expect from these stock investments, and we can think about how much risk are we taking, which is how much money we'll be risking in order to make this profit. So first of all, how do we even measure the risk that we'll be taking? So one of the measures of risk is called the value at risk. So it is a quantile, basically, in the distribution of the relative return. So the value at risk allows us to answer this question. Let's say we have somehow determined that the value of the value at risk of 95% confidence is 1%. Then this means that we are 95% sure that our loss will not exceed 1%. So we know that our relative return has a normal distribution with mean and variance given by the model parameters. And we want to find out the value at risk of a confidence level that we specify, alpha. Usually people would put alpha at, let's say, 95% or 97%, or if you are dealing with some very risk-averse investors, you might say, okay, 99%. So whatever that is, we want to find out the corresponding level of value at risk. So we let's say this value at risk is Q, and then we can just solve this equation to find it out. So what we need for this Q, the condition for Q is that our expected the probability of our relative return is less than our relative return being less than minus Q, meaning that we lose more than Q, the percentage that we lose from this investment is less than Q. And of course, we want this probability to be 1 minus alpha, because that alpha is how confident we are that the loss will not be exceeded. So by writing this expression as a standard normal distribution, we can find out what this Q is, which I have just written out here. And the symbol here, phi, is cumulative distribution function of the standard normal distribution. So if we plug in those model parameters, we'll see that we are actually taking a risk of, as measured by value at risk, of 33.8%, meaning we are 95% sure that our loss will be smaller than 33.8%, meaning there's actually a 1 out of 20 chance that this loss will be greater. So it's in fact a pretty risky investment. Okay, next let's talk about the expected shortfall, which is considered a better risk measure as compared to value at risk. So the question that is answered by the expected shortfall is, if the loss of our investment does exceed the level that we have computed from value at risk, how much can we expect this loss to be? So that means we are looking at a conditional expectation here. That is expectation of our relative return on condition that it is lower than minus Q. Here Q is value at risk. All right, so yeah, we can this in order to evaluate this conditional expectations, and of course we will need to do an integral to evaluate first of all the expectation of our relative return when the relative return is indeed lower than the value at risk. So after a bit of a calculation here, we will find out that this expected shortfall with those model parameters of the drift of the stock being 20% and the volatility of 30%, we will get a 46.4% of expected shortfall in a time period of 1 year. So that means if the market does go against us and it goes so badly that our loss exceeds the value at risk, which we have 95% confidence that it will not be exceeded, but if it is indeed exceeded, then we can expect to lose 46.4%. So as we said, it's a pretty risky investment. So that actually takes us to the next topic here. So if we are going to commit some amount of money to a risky investment, like the one before, how can we limit our loss? So the financial instrument of options allows us to do that. So suppose you are managing your family and friends' money, and you decided okay, the stocks that we have just talked about is risky, but nonetheless, it's still better than other stock investment, and you want to take that risk, and you have calculated your expected shortfall, and you decided, okay, you're not going putting all your savings or your money that your friends and family have entrusted to you. You were putting a little bit. But then you would like to limit your risk to a certain level. Let's say in 1 year's time, you want to report to your investors. And at that time, you really don't want to disappoint them. So let's say in 1 year's time, you want to make sure that you will never lose, let's say, 15% of the investment. Otherwise, we'll be very, very angry. So this is why we may consider using European options. So European call option on a stock allows us to buy the stock at a predetermined price called the strike price on a specified date. That's called expiry date. Then the European put option allows us to sell the stock with a specified price on a specified date. So if we have bought the stock today at a certain price, and we want to make sure that we don't lose more than 15% of our investment in a year's time, we might consider buying a put option on the same stock so that we can at least sell that stock in 1 year at that lower price. That is 15% lower. So we can be sure that we won't lose more than that. So this option gives us the right to buy the stock or sell the stock if we have the call or put option, but it doesn't give us any obligation. So if our stock investment actually goes pretty well and it is well above your initial investment, and you don't need that. Let's say the stock is $100 when you buy it, and you have bought a European put option to protect you against the risk of the stock price going below $85. But in the end, one year later, the stock price goes up actually to $110. You don't need the option. In that case, you can simply let the option expire. There's no obligation on you to do anything whatsoever. And another interesting about options that the European options actually traded on other continents as well is European is just a designation about how the option can be exercised. So that means you can only use your option exactly on the expiry date. There are other kinds of options, for example, called the American options, that allows you to buy or sell the stock anytime from now to the expiry date. But we will focus on European options here. Okay, so next we'll talk about how we can calculate a fair price of a European call option. So as we said earlier, so this European call option allows us to buy the stock on the expiry date at a specified strike price, which we will denote as K here. So that means on the expiry date, which we denote as T here, if the stock price is higher than the strike price, then you will use your option to buy 1 share of the stock at price K, but the market price of the stock is actually ST, and ST is higher than K. So after buying the stock using your option, you will immediately sell that stock and take a profit of ST minus K. So this is a value of the European call option on the expiry date. And the risk neutral pricing theory tells us that we need to use a risk neutral measure, risk neutral probability measure, to calculate the fair price of the of the option. And in this probability measure, the drift mu is replaced by a risk-free interest rate that is applicable to the currency in which the stock is traded. So for example, if the stock is traded in US dollars, this risk-free interest rate is published by the Federal Reserve. I think it is called the SOFR rate, Secured Overnight Financing Rate. And then with this risk-free interest rate and the risk-neutral probability measure, we can calculate today's price of the call option as an expectation. Here, we will need to discount the price of the call option on the expiry date with the risk-free rate applied for the whole duration of holding that stock. Okay, so what follows, yeah, I'm going to tell you a bit about why we need this discounting. This discounting term stems from the time value of money. So the idea is this, let's say your friend Tom promises to pay Jerry £1,000 in a year, but now Jerry, he needs the money now. So he decides to sell his this IOU to Alice. So how much should Alice pay for this IOU in order to receive £1,000 in a year? So suppose Jerry is paid X pounds for this IOU and immediately deposit this amount of money to a bank, which pays a risk-free interest rate R, but then that is nonetheless continuously compounded. So that means in a year's time, Jerry, from his initial deposit of X pounds, will have X times e to the power of R pounds, because there's no risk. So I mean, there's no risk involved in this bank investment. So that means getting X pounds today is exactly equal to only X times e to the power of R pounds in 1 year's time. And therefore, we know that in 1 year's time, this IOU is worth £1,000. And from there, we can solve for X. And that tells us if the risk-free interest rate is 4% annually, then this £1,000 paid in a year is really worth £960 today. So that explains the discounting factor in the pricing formula for European call option. Okay, so what follows is a bit of a calculation of this expectation value. In the end, we will arrive at that very much celebrated Black-Scholes formula. Let me just show you here. So this is formula for the European call option valued at today. And S0 here is again the price of the stock today. Here, people, finance professionals just it's popular to define this two convenience variable D1, D2, and they talk about these two convenience variables in. So if you hear some guy calling you, trying to sell you European options, and they say D1 is that, D2 is that, you know that they are referring to these quantities here. Okay, I think the calculation of the European put option is done in pretty much the same way. And if you carry through the calculations, you will realize that there's relation between the price of the call options, the price of the put option. You can also argue in a slightly different way to get the European put options price in terms of the stock price and the call options price. Okay, I'm running out of time, so I will just stop here. yeah, if you have any questions, I'll be more than happy to answer it as much as I can. Thank you.
Thank you, Dr. Xiaolei, for the presentation. If any student or any other person has any question, we can have 1, 2 quick one.
I
Lisa?
I just wanted to ask if this is the state of the art technology that banks use for putting prices in options, or they also use some sort of human that is there saying, no, I think this option should actually be more expensive than what the method says, or less expensive. There is some human interaction when putting prices on stocks and options, or is all done automatically using this?
Yeah, I mean, all of these calculations are somehow calculated by people who have typically have a math or engineering background, and these values are provided to the traders who will look at these values and hopefully add something else, and then they will make a decision about whether to really invest into the stock, or maybe make a combination of options and the stocks to have some sort of protection, but not all. Because if you really entirely hedge your risk, then then you won't make any money. So this is how it typically works. But of course, I mean, the Black-Scholes formula have been around for a long time, and I mean, it is known to have problems. For example, if you calculate the volatilities using Black-Scholes formula, you will see that it doesn't exactly match the option prices as market, and therefore people have come up with more advanced models of describing the dynamics of the stock price. So there's more research going on let's say better models. Yeah.
Thank you.
My pleasure.
Thank you.